Good morning. My name is Daniel Thomas, and I'm the property correspondent and columnist at the Financial Times. We have today a presentation by one of the key thought leaders on investment in the global economy, followed by a fantastic opportunity to quiz the man who called the economic crisis in a climate today of great economic and political uncertainty. I would ask everyone first to please turn off their mobile phones so we can continue uninterrupted in the next hour. Dr. Roubini is famous for having been the only international economist to announce the crisis back in 2006 and has consistently predicted the global housing and financial crisis since then. His views on how real estate can emerge from the troubles over the last few years in many of the developed markets will prove invaluable, I'm sure. It is my pleasure, in the name of MIPIM, to welcome this morning's keynote speaker. Please join me, ladies and gentlemen, in welcoming Dr. Nouriel Roubini.
Good morning, everyone. It's a great pleasure and honor being here at this great event in front of this distinguished crowd. I remember last time I was in this hall was last May during the Cannes Film Festival. It was the world premiere of two movies in which I had a little cameo role. One was Wall Street 2, and the other was this documentary on the financial crisis, Inside Job, that won last week the award for the best documentary, the Oscars. Unfortunately, here this morning, you're not going to be watching a great film. You'll have to listen to me and my views on the global economy, but hopefully there'll be some good food for thought, if not entertainment. So what I want to do is just to give you my outlook for the global economy, what's happening. I was recently in Davos at the World Economic Forum, and the way I characterized the global economy then was a glass that was half full and a glass that was half empty. There are many positive developments in the global economy and upside risk, and I think we should recognize them, but there are also clouds over the global economy, and there are downside risks and vulnerabilities is worth kind of considering to be realistic about what may be happening next. If I had to start with the positives, I think there are many things that are actually going on in the global economy today that are actually going in the right direction. With the very severe economic and financial crisis, but there has been a global economic recovery for the last 2 years. And if you look at the last economic indicators, these forward-looking indicators of economic activity, both in emerging markets and advanced economy, they suggest not only positive growth, but growth that is accelerating, not just in emerging market economy, but also in the United States, in many parts of Europe, and even in Japan. So there is positive economic growth, and growth is accelerating in the last few months. The second positive about the global economy is that the kind of a tail risk that people were worrying about last year, the tail risk of outright deflation, the tail risk of a double-dip recession in the US and other advanced economies, the tail risk of a disorderly breakup of the monetary union or disorderly default in the Eurozone, those tail risks today are lower probability events than they were a year ago. Not zero probability event, but certainly the risk of those tail risks is smaller today than it was a year ago. So that's also a positive. The third positive about the global economy is that if you look at the balance sheets and the P&L of corporates, especially the high-grade, low-leverage corporates in the United States, in Europe, in advanced economies, they're in very good shape. They took the crisis as an opportunity to reduce cost, especially labor cost, that has been, of course, painful for the unemployment rate. But these corporates have become lean and mean, they're highly profitable, earnings have been surprising on the upside quarter after quarter, they're sitting on a pile of cash, $2 trillion of cash available for investment, for job hiring, for M&A activity, for financial transaction. And as these corporates become more confident about the global economic recovery, they're more willing to spend. Of course, one question is, are they going to spend, going to hire in slow-growing advanced economies, or are they going to do most of it in more fast-growing emerging market economies? That's an open question, but certainly their financial conditions are much stronger than they were 2 years ago. The fourth positive about the global economy is the rise of emerging market economies. There are now multiple poles of growth, engines, locomotives of growth, not just the United States and other advanced economies. And the story is not only about China or India or about the BRICS, but it's also about the rest of emerging Asia, about the positive things that are happening in emerging markets in Latin America, in Central Asia, even in the Middle East where there is turmoil today. Given high oil prices, the opportunity for high economic growth are there. So most emerging markets are growing very fast. And that's not just cyclical. It's a permanent shift of economic power from west to east, from north to south, from advanced economies to emerging markets. And for the purpose of this conference, property and real estate, I would say that the growth of emerging market is going to be medium and long-term positive for real estate, commercial and residential. You have fast-growing economies where income and wages are growing. You have industrialization. You have urbanization, massive scale in China today, but it's going to be increasingly so in India and most other emerging markets. And as you have urbanization, industrialization, and fast growth, demand for real estate and property rises. Huge demand for residential real investment, for commercial real estate, from retail, offices, transportation, infrastructure, and you name it. So the long-term trends of emerging markets are certainly positive for the property sector. The fifth positive about the global economy is that last year for financial market was a year of risk on and risk off. Risk was off and risk aversion was high in the spring during the Greek crisis. Risk was off again in the summer when people were worried about a double-dip recession in the United States. By the fall of last year, things started to improve in financial market and equity markets started to rise. That was the result of quantitative easing number 2 by the US Fed, the result of another fiscal stimulus in the United States, the results of the European patching up the problems of the periphery of the Eurozone and coming up with official financing to backstop banks and governments in trouble. But the year ended actually on a positive note. And that rally in equity markets and reduction in credit spread continued into the beginning of this year. Of course, the clouds coming from the Middle East have led now to an increase in risk aversion, but the current global equity market correction has been very modest compared to the one we had, for example, in the spring of last year, where the problems of a small Greece led to a 20% equity market correction globally. So you can tell a story that as the global economy recovers and the economy surprise on the upside in terms of recovery, asset prices can go higher. If asset prices go higher, there are positive wealth effects. Reduction in credit spreads further stimulates economic activity. And you could have a virtuous circle where the real economy improves, financial markets improve, as opposed to that vicious circle that you saw between 2007 and 2009 when asset prices were falling and real economic activity was contracting. So you could have positive surprises. Now, these are the positives about the global economy, and I would say we should not underestimate the power of these positive factors that are driving global economic growth, both in advanced economies and emerging markets. Let me talk now about what are the potential downside risks and the vulnerability. And certainly, the one that is key in the mind of investors today is the turmoil in the Middle East and the rise in oil, energy, food, and other commodity prices. I'm going to get to that point in a moment, but I'd like to first address a number of the other concerns. The first observation I'll make is that in most advanced economies, the recovery is going to be still anemic, subpar, below trend, more like a U-shaped recovery rather than the V-shaped recovery of previous economic recovery. Why? The crisis was caused, of course, by too much debt and leverage in the private sector, households, financial institutions, even parts of the corporate sector, and those debt ratios remain still very high in the private sector, while at the same time, in the last few years, we've seen a massive releveraging of the public sector with large budget deficits. So over the next few years, a painful process of private and public sector deleveraging is going to occur, and everything else equal, that implies that there'll be positive growth in advanced economies, but that growth is going to be weakened by the fact there is this burden of private and public debt. They need to spend less, save more, as a way of reducing these debt burdens in the private and the public sector. So that's one constraint to growth. The second issue is related to the first one, is that, as you know, there is significant sovereign risk and rising sovereign risk in most advanced economies. Of course, the bond market vigilantes have already woken up in the periphery of the Eurozone, Italy, Spain, Portugal, Greece, Ireland, you name it. But let's not forget that we have large budget deficits and large stocks of rising public debt in the United States, in the United Kingdom, in Japan, and most of the other advanced economies. So the question of sovereign risk, of public debt sustainability, of the willingness, ability of government in advanced economies to tackle these fiscal problems is going to remain a serious one for many years. And in addition to the official public debt, as you know, there are also contingent liabilities of the public sector deriving from aging of population in most advanced economies. That is leading to social security system, pension funds being unfunded, the rising cost of healthcare for the elderly. So you have public debt officially, and you have also contingent liabilities or unfunded debt as well. So that's a second problem. The third problem in the global economy derives from the economic and financial trouble still existing in the periphery of the Eurozone: Greece, Ireland, Portugal, Spain, Italy, potentially other countries. The fundamental problems of this economy are chronic and are not going to be resolved anytime soon, even if the Eurozone is now much more willing to backstop the weak governments and the banks and support the euro. There are problems of large public debt and deficit, but also large foreign liabilities of the private sector, especially in countries like Ireland or Spain, where there was a housing boom and bubble that went bust. So you have public and private debt and deficit that are significant and have to be rolled over. You have a problem of a loss of competitiveness of the periphery of the Eurozone. Countries that were losing market shares to Asia already a decade ago because of exports being labor-intensive and low value added. Then a decade of wages rising more than productivity, and unit labor costs rising, and then the sharp appreciation of the euro being the final nail in the coffin of competitiveness. And then you have the problem that in most of the periphery of the Eurozone, there is either no economic growth or negative economic growth. Greece, Ireland, Spain are still contracting, while economic growth is barely positive in Italy and in Portugal. So you have public and private debt and deficit. You have lack of competitiveness on the external side, large current account deficits, lack of structural reform, lack of economic reform. How are you going to square these things, restore economic growth? I think that even if a disorderly breakup of the Eurozone is unlikely, the challenges of the Eurozone remain. The fourth problem I think we should recognize is that while in the short run the United States is doing well, this year you could have economic growth of the order of 3% or so, there are significant problems also in the United States. The private sector deleveraging of the household sector has been postponed so far this year and next year because the household sector received another tax cut or transfer payments of $1 trillion, but that $1 trillion has been financed through an increase in the budget deficits of the same amount, another $1 trillion of public debt. So in the US, we are postponing the private sector deleveraging by even more releveraging the public sector. Eventually, the process of deleveraging the private and the public sector is going to continue again, and that's going to slow down growth, especially starting with next year. But there are four issues that I think that are not addressed in the United States. One is that the unemployment rate remains high, and job creation is still modest, just barely enough to satisfy the increase in the labor supply, and therefore unemployment rate is going to stay high. Including discouraged workers and partial employee worker, actually unemployment rate is not 8.9, but rather 16%. The second problem in the United States is, unfortunately, if there is one sector of the US economy that is already double dipping, is the housing sector. Demand was artificially boosted last spring to a tax credit. Supply was constrained by an effective moratorium on foreclosures. After the tax credit expired, demand fell, supply now is rising. Since August, unfortunately, home prices started to fall again, and that has negative wealth effect on consumption, and it pushes millions of more households into negative equity, with the risk of many more of them walking away from their homes. And high unemployment rate and a double dip in housing implies that losses for the financial system may be higher than what the market is pricing. The third problem in the United States is the fiscal deficits of the state and local governments. They are very severe. They're starting to address them, but it's putting pressure on the municipal bond market. And the fourth problem in the United States is that while Europe and UK are starting to address their own fiscal problem, the US decided to kick the can down the road. There is political gridlock in Congress. Democrats and Republicans are completely divided. Republicans are against tax increases. Democrats are against spending cuts, especially entitlement spending. and we have a world in which the US can borrow at 0 rate on the short end and 3.5 on the long end, the path of least resistance politically is to kick the can down the road, keep on running $1 trillion budget deficit this year, next year, into the next administration. The risk is that at some point the bond market vigilante is going to wake up in the US the way they did in Europe. If there's going to be a bond market revolt, the increasing long-term interest rates is going to likely to crowd out that recovery. So those are the risks from the US. Let me talk briefly about emerging market economies. The strength of emerging markets, high economic growth, is also a source of vulnerability. In these emerging markets where there is overheating, where there is excessive credit growth, where there is fraud in some of the financial markets, there is a risk of rising inflation. And in emerging markets, as you know, 2/3 of their consumption basket is oil, energy, food, and transportation. So the rise in food and energy and commodity prices has a much more significant effect on headline and core inflation than in advanced economies, even before you had this shock in the Middle East. So the question for China and many emerging markets is, can they tighten monetary policy and use the exchange rate to reduce inflation and maintain economic growth and achieve a soft landing of their economy rather than a hard landing? Many of these emerging markets are behind the curve in terms of credit controls, in terms of monetary tightening, in terms of allowing the exchange rate to appreciate or control imported inflation. The risk is there's going to be a hard landing rather than a soft landing. It's a low-risk probability event, but certainly the rising commodity prices make that trade-off between maintaining high growth and controlling inflation more difficult than it was in the past. That leads me now to the question about what's going on right now in the Middle East. The reality is that almost nobody predicted this economic political turmoil, and we don't know whether this political turmoil and uprising are going to stabilize in the next few months or whether they're going to spread to many more countries with threat to the supply of oil and energy in other countries other than Libya. The reality is that you can tell a scenario when things stabilize politically and oil prices, while remaining high, they gradually fall to more sustainable levels, but you can tell also a scenario in which the turmoil could exacerbate with upside risk to oil and energy prices. Now, what are the effects of this rise in oil prices? One effect is on inflation, and that effect on inflation is going to be much more sharp in overheating emerging markets where oil, energy, and food are a large part of the consumption basket. And these countries are behind the curve in terms of policy tightening, and therefore the risk of double-digit inflation is rising in many of these emerging markets. In the case of advanced economies where there is a slow recovery from these financial crises, the risk to inflation is much more modest. Yes, you might have some rise in headline inflation gradually, but core inflation is not going to rise very much. And it's not going to rise very much because there you have a slack in the goods market, with capacity utilization being still low in US, in Europe, in Japan. You have a severe slack in the labor markets where unemployment rate is close to 10%, workers don't have wage bargaining power, wages are growing less than productivity, and unit labor costs are falling. And in some economies like the US, UK, Ireland, Spain, and so on, you also have a slack still in the housing market where the bust has led to a longer-term slump in terms of excess capacity. So I worry less about inflation becoming a severe problem at current levels of oil prices in advanced economies. Of course, if oil were to go to $140 or $150 per barrel, the story could be different. So the impact of oil prices is more significant in inflation in emerging markets, less significant in advanced economies. There is also an impact on economic growth because rising oil prices are a negative terms of trade effect on advanced economies, and it leads to a reduction in income and therefore in consumption. So you may expect a slowdown in economic growth. So far, it's going to be a slowdown in economic growth, not a double-dip recession, but if oil were to reach a level of 140 or 150, and that's a big if, the turmoil in the Middle East becomes much worse, then certainly the risk of a double-dip recession, the risk of a stagflationary shock where you have a recession and rising inflation will be a bigger risk for many advanced economies, for the UK, for the peripheral Eurozone, eventually even for the United States. So current level of oil prices are a drag on growth for the global economy, but a modest drag, and they lead to a modest increase in inflation. Further shock, they have more destabilizing effect. They would also negatively affect business confidence, consumer confidence, investor confidence in a way that could slow down growth more than otherwise. So that's a risk, but we don't know yet what the political developments are going to be. My final observation will be the following one, that is another downside risk. I've said at the beginning that the glass is half full, but it's half full because for the last 2-3 years, we've had, on one side, a massive amount of monetary liquidity injections in the global economy, near zero policy rates in advanced economies, quantitative easing 1, quantitative easing 2 in the US, in Japan, in other economies. So the glass has become full because liquidity has been huge, chasing assets and leading to asset reflation. And on the fiscal side, until recently, we had massive fiscal stimulus in US, in Europe, in Japan, in emerging markets. But if you look at the road ahead, there is going to be less monetary and fiscal stimulus. On the fiscal side, the Eurozone is already retrenching, cutting spending, raising taxes because the bond vigilantes are forcing it in the Eurozone in the United Kingdom. But even in the United States, where we're kicking the can down the road, there'll be fiscal consolidation. It's already occurring at the state and local level. It's going to start to occur also at the federal level as the Republicans in Congress are pushing for spending cut. So even in the US, the fiscal side is going to be a drag on economic growth, not just in the Eurozone, not just the United Kingdom. On the monetary side, with rising inflation, the European Central Bank has already signaled they're going to start to increase interest rates because they worry about inflation. Inflation is already well above target in the United Kingdom, and the pressure on the Bank of England to raising interest rates, if not today, in the next few months, is going to be significant. And even in the United States, where policy rates are going to remain at zero after the end of QE2 in June, we're not going to have QE3, most likely. We're not going to have QE3 because growth is positive, because inflation at the headline is rising, because Republicans are in control of the House and they're bashing the Fed, saying that the Fed is threatening to debase the currency and lead to inflation, and because now a larger number of the members of the FOMC of the Fed, the 3 new governors, are all more hawkish than Ben Bernanke, Kocher-Lakota, Prosser, Fisher, and therefore even the Fed is going to be more cautious. So the closing question is the following one. If the glass is half full because we had monetary and fiscal injection, but in the next few years we're going to have fiscal austerity and exit from zero rates in the UK, in the Eurozone, and eventually next year even in the United States, is there enough resilience in the private markets? Is there enough resilience of consumption, of the corporate sector, of CapEx, to have resilient economic growth when part of the monetary and the fiscal stimulus is going to go away? I think that's an open question. So there are strengths, there are upside risk, the real economies are doing well and they're recovering, but certainly some of the downside risks I talked about, certainly those coming from the political risk in the Middle East, the risk of rising food and energy prices may lead to a slowdown of growth and increase in inflation and some of the downside risks that I referred to. So the glass is half full, but is also half empty, and we're going to still be in a world in which there is macro uncertainty and volatility, not just macro, financial, fiscal, political, policy, and also geopolitical. So it's still an uncertain world in which there are upside risk as well as downside risk. I'll stop here, and I'll be happy to take some questions. Thanks for your attention.
Thank you very much, Dr. Roubini. That was fascinating insight. In a 20 minutes span, we've covered the entirety of the world economic and political situation. And I think there's been a number of questions which certainly came to my mind, which I'd like to ask you before we open it to the floor at least. First of all, just going back to your emerging markets point, do you think there's been a fundamental shift of economic and political power to the East? And what can the Western states and cities do to maybe not compete, but complement what's going on elsewhere?
Yes, I think there is a major shift of global economic power, and the share of global GDP and global growth is going to be accounted by emerging markets, not only in the East. As I pointed out, interesting things happen in many parts of Latin America and other parts of emerging markets. This is a secular shift. Even if the US, Europe, and Japan were to grow at their potential growth rate, and potential is around 3% for the US, maybe at best 1.5% to 2% in Japan and the Eurozone, potential growth in most emerging market economies is between 5% to 8%. So that process of convergence of global GDP levels and per capita GDP is going to be gradual, but it's going to imply that there is a larger share of global GDP and global economic growth accounted by emerging markets. And with rising economic, financial, and trading power, there is going to be also a rise in political power. That's why the G7 became obsolete as the body for global economic and financial governance, and now global economic power has been moved from the G7 to the G20, when the half of the G20 is comprised of those systemically important emerging market economies. So I think that's a long-term shift.
So is the strategy now for some of the more advanced economies, the developed cities, now to answer the consumption needs of the emerging East? Is it about looking to find your customers over there, be it London as a financial capital, or Paris as a financial capital, or the US and New York as a producer of goods? Is it about sort of finding your customers over there now?
Well, I mean, if you talk to global corporations, certainly they see that a lot of the growth is going to be in emerging markets, and as I said, well beyond just China and India, and therefore capital flows, both in terms of short-term capital inflows, foreign direct investment, a lot of it is going into emerging market economies. And I would say global firms, whether they are in real estate or corporate sector or so on, firms from Europe, firms from the United States, firms from other parts of the world, are highly qualified to be able to exploit the fact that there's going to be a huge demand for goods and services, for financial services, for real estate services and so on, coming from the fast growth and urbanization and industrialization of emerging markets. But let's not forget that there are also rising multinational corporations and firms in those emerging markets. So it's not going to be a one-way thing. There's going to be a rise of power of firms, large-scale firms, in most of these emerging market economies, many of which are becoming global and many of which are starting to aggressively invest also outside of their own regions.
Mm-hmm. I mean, is Europe in particular, and perhaps the UK, in positioning itself as a sort of, well, does it want to be Taiwan as opposed to Japan, as it were? Do they want to create a more export-led economy which could support the growth that we're seeing at the moment?
Well, the situation in many advanced economies is that since domestic demand is relatively weak because you have these private and public sector deleveraging, so domestic demand is growing more slowly. In order to grow at potential, you have to have an improvement of net export growth, especially in the countries that had a housing bubble went bust and had large current account deficit. The trouble, however, is that the US needs a weaker dollar to grow its exports to grow faster, but Japan needs a weaker yen to grow its exports. The UK needs a weaker pound to grow its exports. The Eurozone, especially the periphery, needs a weaker euro to grow its exports. Even the Swiss have been intervening to prevent the franc from appreciation because they're worried about losing competitiveness. And China and emerging markets that have currencies that are undervalued and are running current account surplus, they're aggressively intervening, the Chinese, to prevent their currency from appreciating faster, to maintain export-led growth and industrialization. And if China doesn't move fast enough, every other emerging market from Asia to Latin America says, I don't want to lose market shares to China, and therefore I'm not going to let my currency appreciate very much. So we're in a world in which everybody wants a weaker currency, but that cannot be an equilibrium, because if my currency is weaker, somebody else's has to be stronger. You cannot have all currency relatively weak to each other. And we're in a world in which if my trade deficit becomes smaller or my net exports are improving, somebody else's net exports have to worsen, because the sum of all trade balances in the world is equal to zero. We don't trade with Mars. And therefore, it's a zero-sum game on currencies, and it's a zero-sum game on trade balances. And that's the source of the currency tensions, of the currency wars that eventually, if they're not resolved, could lead even to trade wars. Mm. So we have this fundamental problem on currencies and exports and trade balances.
Mm. And what effect would increasing interest rates have on the situation? And clearly, as you say, the ECB signaled that there is, there's an intention there, and as you say, it's likely that the Bank of England will follow suit. Do you find? Would you say it's making the eurozone less competitive as a place to trade?
Well, the trouble of the Eurozone is that you have a core starting with Germany is now growing robustly, and you have a periphery that's still either not growing or contracting. So in the core, inflation is rising, growth is fast, so moving away from 1% rate to higher, normalizing makes sense for Germany, but in the periphery, you need actually low interest rates for much longer. And I think that's going to be the tension in the Eurozone, that rising interest rates are going to make the sovereign debt problems of the periphery worse, going to make the problems of the banking system worse, are going to lead to a double-dip recession, and the strengthening of the euro is going to occur as the interest rate differential between Europe and US becomes wider. It's going to hurt further the competitiveness of the periphery of the Eurozone, meaning a euro at 140 is totally sustainable for a Germany that is uber competitive. Germany can live even with euro at 150, but for the periphery of the Eurozone, even 130 was too strong, and the euro should be much weaker than it is right now, 20, 30% lower. The trouble is that the ECB policy and the strength of the core and of Germany imply strengthening of the euro rather than weakening, and that's going to, in my view, exacerbate the economic, financial, fiscal, and banking problems of the periphery of the Eurozone.
So has Germany become too powerful in the system? If what it says happens, and to the detriment of other countries, is that a problem?
Well, it's going to be a problem because Germany is being successful and run ever larger current account surpluses, because that was matched by the current account deficits of the periphery. And therefore, people talk about the relation between US and China. There is a similar relationship of vendor financing within the Eurozone, with the strength of Germany being represented by the weakness of competitiveness of the periphery. And therefore, those kind of economic and financial tension within the Eurozone are going to stay with us in some sense. So the periphery needs a weaker euro, it needs easier monetary policy, needs a slower rate of fiscal austerity, but the markets and the center is imposing the opposite.
Yeah. And is there a sense that, you mentioned QE2 in the US, and there have been similar measures in Europe. I mean, is there a sense that the last 12 months have been a bit artificial, and the asset prices have generally gone up, actually, be it real estate in the prime sector, be it equities, bonds. Is this coming to an end now?
Well, the recovery of asset prices was partly driven by the fact we stopped this Great Recession, we prevented a Great Depression, was driven by the fact there has been an economic recovery, and of course, asset prices were in a bubble before the crisis, fell below fundamental value at the peak of the crisis, so some of that recovery, of course, was justified by the improvement of the global economic fundamentals. The question is whether there is beginning of fraud in some asset markets in some parts of the world. We have zero policy rates, we have QE2 in the United States, we have a wall of liquidity chasing assets. Some of that money has gone into commodities, and part of the increase in commodity prices might be a monetary phenomenon. A lot of the money in terms of capital flows is going to emerging market economies. There are these pressures in terms of monetary creation, credit growth, if not bubble, certainly fraud in some of the financial markets, maybe even in some of the real estate markets of some of these emerging market economies. And the question is, can the emerging market economies manage this inflow of capital in a way that avoids actually overheating in the real economy and the financial market? The trouble is that you have zero policy rates in the US, and you have China shadowing the US dollar, and if China shadows the US dollar, every other emerging market shadows the Chinese RMB, and the combination of China and other emerging markets effectively through semi-fixed exchange rate adopting the monetary and credit policy of the United States is dangerous, because zero rates might be optimal still for a US where there is barely recovery from a severe financial crisis, but in a China that is growing at 10%, or in India growing at 9%, or a Brazil growing at 7.5%, of course there has to be policy normalization, and that policy normalization on the monetary side is slowed down by the fact that all these economies worry that tightening too fast is going to strengthen their currency even more and lead to even more capital inflows and weakening of their own external competitiveness. So that combination, if continues excessively over time, could be a source of overheating, inflation, asset and credit bubble that eventually down the line could become dangerous.
And do you think the reaction of certainly Europe in terms of interest rates is an overreaction to the fears of inflation? Do you think that oil prices will lead to a real inflationary boost in, say, wages and demand, or do you think it's going to sort of tail off in the next few months?
I think that the ECB has overreacted because while headline inflation in the Eurozone is now slightly above the target of 2%, was well below 2% for the last 2 or 3 years, and while headline inflation is 2.4, core inflation in the Eurozone, like the United States, is around 1%. And I don't believe there are going to be second round effects because labor markets are weak. There's also excess capacity. Wages are not growing more than productivity. In US, labor costs, unit labor costs are falling. In Europe, they're not rising. And about 70% of cost of production are labor costs. And therefore, unless you have those second round effects on inflation, there is less wage indexation today than it was 30 years ago. There is less power of unions in many parts of the world. Therefore, the feedback from commodity prices to wages to prices is going to be much more limited. And given the weakness of the periphery, given the financial problems, given the sovereign debt problems, I think the tightening too much too soon could be dangerous for the periphery of the Eurozone.
And just to bring the interest rate question to a real estate level, I mean, one of the big issues I think being discussed here this week at MIPIM is the deleveraging of the sector as a whole. As you know, there's an awful lot, billions and billions of dollars of bad debt still within the system, within the banks, on the balance sheets of investors, and there's very little new debt coming through, actually focused on real estate. And how does this get worked out? Is there any easy solutions for banks? Can they get through this in the short term, or is it going to be a decade before we see proper real estate lending come through again?
Well, there's an ongoing process of deleveraging. Many banks in the United States have recapitalized faster than those in Europe. I think the Europeans have been behind the curve. There are still many bad assets on their balance sheets, and how much more bad assets are going to be there depends on the macro side, depends on how much economic growth, how much unemployment rate, and how much more price deflation in the housing market in the US and other countries that had a housing bubble that went bust, like the UK, like Spain, like Ireland, like Dubai, like Iceland. So we're closer to the bottom of this housing recession in terms of quantities, but excess supply relative to demand in a number of these countries implies that price deflation may be still ongoing rather than otherwise, and that price deflation implies more people into negative equity, more people walking away from their homes, and potentially bigger losses and bad assets for the financial system. So that's certainly one of the risks in advanced economies. Of course, in emerging markets, the opposite. There is actually frothiness in many of these real estate markets. Of course, some of it is justified by the long-term fundamental, urbanization, wage growth, income growth, industrialization. Demand for housing, for commercial real estate is growing fast all over Asia. But I would say even in Asia, policymakers are starting to worry about some of that frothiness and starting to have greater control on underwriting of mortgages and credit controls in real estate, from China to India, to places like Korea, Singapore, Hong Kong. And there is some degree of frothiness even in some of the real estate markets in some of the advanced economies, Sweden, Norway, Finland, Australia, Canada, and so on. And certainly countries like Singapore, Hong Kong, or Korea that are put among the emerging markets, but in terms of their per capita income, they're more like advanced economies. So I think one of the policy challenges in emerging market economies, how you can maintain the growth of the economy, how you can maintain the growth of real estate, but making sure that things don't get out of control and you don't have excessive amounts of frothiness that eventually may lead to a bubble and a downturn. And it's a delicate balancing issues for regulators, supervisors, and policymakers in many of the emerging markets, but also in some of the advanced economies where housing certainly has been on the upside for the last couple of years.
Mm-hmm. I'm sure many people would agree that the long-term income from property is very linked to GDP growth. I mean, and so just to sort of pinpoint this down, I mean, what do you think the threat is to medium-term GDP growth in the next, let's say 5 to 10 years? Actually, it's oil rising, oil price rises, cutting the growth slightly. Is there any other risks which could ultimately affect growth going forward?
Well, again, I would distinguish between advanced economies and emerging markets, because in advanced economies, potential growth is lower than emerging markets, and possibly potential growth is going to be falling in the next few years, and it's going to fall for a number of reasons. One, you have aging of population, so everything else equal, your growth rate is faster if you have high population growth and is lower when you have lower population growth. That's why the growth rate differential between, say, US compared to Europe and Japan is driven partly by demographic. Secondly, you have that when you have aging population, probably there is less investment, less savings, and that feeds back to lower productivity of labor and lower economic growth. And finally, as I pointed, in many advanced economies, the high burden of private and now public debt implies that as you have to deleverage, you have to spend less in the private and public sector, you have to save more, and as you spend less and save more to reduce your debt, everything else equal, final demand is going to be growing more slowly than otherwise. So these are all kind of potential negatives for economic growth, and so that the aging of population may be also a source of lower long-term demand for housing and other forms of real estate. In fast-growing emerging markets where population growth is still significant and high, with a few exceptions, where labor productivity growth is rising, where there is urbanization, where we have industrialization, it's a different story for what's going to be happening to long-term demand for both commercial and residential real estate, on top of demand for infrastructures, transportation, and all the other things are going to be significant drivers of economic growth in the property sector.
So there's actually two classes, really. It's not one glass. It's sort of one glass is half full, it seems, in emerging markets, and one glass is slightly half empty in the other side of things.
Yes, in relative terms.
In relative terms, yeah. And is there a risk of a second subprime crisis coming back to haunt the US, or is the US recovery more robust than that?
Well, so far, as I said, this year we're going to have 3% growth, even if we've stolen some of that growth from the future, because as pointed out, the consumption growth of the last few quarters has been driven by these tax cuts and transfer payments and unemployment benefit and so on that are eventually have to be drawn out as you have a deleveraging of the public sector. So when the deleveraging of the public sector is going to start in earnest in the next couple of years, the private sector is going to have to deleverage again, and that's going to slow down economic growth. If oil doesn't go much higher, we're not going to have maybe a double-dip recession. I think the tail risk of that is lower. If oil or other shock were to lead to a double-dip recession, as I said, it's a big if, then of course you could have another significant bust in the financial system because the losses of the banking system depend on growth, unemployment rate, and house price deflation. The worse is that macro outlook, the more there is a risk of further financial distress, and certainly, as I pointed out, unfortunately, one sector of the US economy that so far is not recovering or is double dipping is still the housing sector.
So there's a risk there, obviously. It's, right, I think it's about time that I stopped monopolizing your time and opened up for questions to the floor. I would like to ask everyone, when they do ask questions, to introduce themselves and to say where they're from in terms of their company. I think also if you can keep your questions to a relatively short one sentence, that would be helpful, just so we can get in as many questions as possible in the time we have left. I'd also ask the press who are in the room to wait until after the main session, because there is a special press conference, so we can take questions directly after that. But with that, can I please open the questions to the floor? Does anyone have questions? We should have at least 4 roaming mics around, so if we can, there we go.
Thank you very much. I'm coming from Turkey, and among all those countries, I was expecting to hear how would you evaluate Turkey within these developments, being a bridge in between the BRIC countries and Europe? If I can have your comments, please.
Well, I'm quite optimistic about the long-term economic prospects of Turkey. I think that among emerging market economy, there is a group of countries that have the following features that are positive. There is still large population growth, so there are large economies with large population. They have a significant domestic markets, but they're also open economies. And unlike China, where population is declining and consumption is still only 36% of GDP, in countries like Turkey, in countries like Indonesia, Brazil, India, you have actually consumption being 2/3 of GDP, credit growth still being constrained and limited, leverage in the household sector and the financial system modest, so large domestic demand, large share of consumption in GDP, a growing population and sound levels of debt and leverage in the financial system, the household sector can be a source of long-run fast economic growth as long as a series of macro, fiscal, and financial reforms are continued so that the institutional environment remains sound. And certainly, Turkey being a link between Europe and Middle East and Central Asia, in terms of its own location, in terms of its own comparative advantage, in terms of having a strong industrial base and a sound financial system, can be a very fast-growing economy. Of course, Turkey has its own challenges, unemployment rate being still high, current account deficit being large, oil dependence being significant, having to do more structural reforms and things of that sort, but conditional on those reforms being made, actually, you can be bullish about Turkey and many of these other emerging market economies as well.
Thank you very much. Any other questions? Man there.
Thank you very much. Ilya Kutnov, Kensington Advisors. I'm coming from Russia. Dr. Roubini, could you please tell me what is the economic outlook for Russia, in your opinion, given the different oil price scenarios that you mentioned earlier? Either a significant drop in prices or continuing growth in the oil prices? Thank you.
Well, of course, there is a cyclical component of what's going to happen to the Russian economy that depends on oil prices. The higher there are oil prices, the stronger is the Russian economy, given the Russian economy is still significantly demanding on oil, energy, and commodity exports. So the recent increase in oil prices, of course, improves the fiscal balance of Russia, improves the current account, improves economic growth. But I would point out that in the case of Russia, there are significant long-term issues that you have to worry about. And I'll give you an example. Take last year when there was a global economic recovery and oil went from $30 a barrel during the crisis to 70, 80. While growth in India was 9%, growth in China was around 9%, growth in Brazil was 7.5%. In spite of rising oil prices, in Russia you had growth of only 4.5% last year. That implies that there are some fundamental constraints to potential growth because it's an economy that is not very well diversified. The value of the ruble is perfectly correlated with oil prices. It's mostly oil, energy, and so on. The attitude until recently towards foreign direct investment has not been friendly. Investors foreign have been worried about expropriation risk and kind of property rights and things of that sort. Of course, the government now is signaling a change, but there has not been significant structural reforms as a way of diversifying the economy and increasing productivity and long-term economic growth. So you have this perverse situation in which growth is low, but inflation is already close to double digits. And unless those structural reforms are going to be accelerated, then the growth of Russia is going to be constrained. So potentially Russia can grow very fast. A large country with lots of natural resources, with also large, still significant skill of the labor force, human capital, education, sciences, you name it. But unless there's going to be a faster rate of political, structural, and institutional reforms, the growth rate of Russia may be constrained on the upside in spite of rising oil prices.
Thank you very much. And maybe over there, this man at the front, and then we'll have the chap behind.
Thank you. My name is Stavros Borgis. I'm from the United States. It's well known and accepted that the housing bubble in the United States, the high rate of foreclosure, hinders the economic growth. Now, given the stubbornly high rate of foreclosure continues, do you see the end of the tunnel? Have we bottomed out, or is still more to come?
Well, as I pointed out, there is still this excess supply of housing, both new and existing homes, and the pace of foreclosures may not be as rapid as it was in the last few years, but it's going to remain kind of significant. And the weaker is the economic growth, the more there is price deflation, the more there is unemployment rate, the more we're going to see of these things. I would say that quantities in the housing market have probably bottomed out. From the peak, both housing starts and sale have fallen by about 80%, and now they're starting to recover gradually and very gradually, both demand supply, but in the last few months, supply has been increasing faster than demand as you got the tax credit expiring and now this effective moratorium on foreclosure being phased out, and therefore there's still some downside price adjustment, and the more there is downside price deflation, the more you're going to have people underwater in their homes and negative equity, and if that combined with low wages or no jobs implies more people are going to walk away from their homes. In the US, mortgages being non-recourse loans, the incentive to walk away from your home if you're negative equity significantly or a challenge in terms of income is still significant. So I fear that while the quantities might have bottomed out and started to rise gradually, the price adjustment in housing in the United States has not yet bottomed out. Of course, there has been already more than a 30% price correction, so the downside risks are more limited than 2 years ago. But I think that since August, Case-Shiller price index has been falling, and unfortunately it's going to be falling for quite a while longer before it bottoms out.
Is there anything the US government can do to help that? If there's a fundamental oversupply of housing in the US, you can't just go around addressing that by...
Well, there were some proposals by the government, some of which were implemented to renegotiate debts and reduce foreclosures. Even the political support for this proposal is now phasing out in Congress, and some of those things are going to be eliminated. And even the administration proposals about the future of Fannie and Freddie and the GSEs implies a smaller role of the government in backstopping the housing market long term. It's right now a level of discussions, nothing has been implemented, but if there's going to be less of a role of housing, less incentive tax and otherwise to housing, everything else equal, that's going to slow down the point at which there is going to be a recovery of that market. We may want to have less government intervention in the housing market because of the distortion it created, but in the short run, actually that's a further negative rather than a positive.
Mm-hmm. Very good. And the chap back there.
Thank you. Luis Irastorza from Spain. I would like, Mr. Roubini, I would like to listen your opinion on the probability of international agreement on climate change, and the impact, if you think it's probable, because Kyoto is finishing in 2012, so the possibility seems quite big. What would be impact on developing and developed countries should it happen in the short term? Thank you.
Well, so far, the international kind of negotiation to get an agreement on global climate change have not been successful. Cancun was a failure, Copenhagen, you name it. I think there is a significant reach to reach an agreement, because unless we address this problem in the long run, of course, with global climate change, greenhouse emission, that's going to be a negative for economic growth. But in a situation in which growth is still anemic in most advanced economies, and where emerging markets are saying, I don't want to jeopardize my own economic growth by imposing restrictions that are excessive, I think that those agreements are going to be difficult. And I think that even in China now, there is a different attitude towards global climate change, in part because they're worried with a rising middle class that having unhealthy water, unhealthy air, diseases is going to be an issue. And they're also realizing that they have to become more energy efficient, because if they're not becoming more energy efficient, every time they grow fast, commodity prices spike. And since they import commodities, that's a negative in terms of trade effect on them. So there's a greater awareness that not just for environmental reasons, but also to have sustainable economic growth, actually, you need to have to do something with global climate change. That's why the Chinese actually have been aggressively investing in alternative energy, green economy, solar panels, you name it. But that's going to be only a gradual process. So in the long run, we need to address these things, because if we don't do it, the effects on growth are going to be negative. There is pressure on resources, water, air. Even the food issue is certainly related to some of these environmental changes. Last year, you had fires in Russia or in Australia. You had floods in Pakistan, in China, other places. We should not underestimate how much some of that global climate change is actually affecting agricultural production, in addition to a variety of natural disasters that are actually human disasters, they're not natural disasters. So we have to address these things, but I don't think we're going to reach a strong agreement anytime soon.
Thank you very much. And this lady here.
Audrey Klein, Park Hill Real Estate. About 10 to 15 years ago, Japan had a similar GDP to debt ratio as the US and Europe do today, so around 350%. Today, Japan's GDP to debt ratio is around 550%. Can you address how Europe and US can stay out of the same traps that Japan fell into? I mean, clearly they were largely unsuccessful at correcting their GDP to debt ratio.
I think you point out a valid issue is that excessive amounts of debt and leverage are eventually dangerous. We know that many financial crises have been driven by too much debt and leverage and risk-taking in the private sector, whether it was the households, whether it was the financial system, whether it was the real estate sector or the corporate sector. And the crisis that started with too much private debt now has morphed into a crisis with too much public debt because you had automatic stabilizers, you had countercyclical fiscal stimulus to prevent the recession from becoming a depression, and three, we decided to socialize the private losses and the fiscal cost of bailing out banks, other financial institutions, households, in some cases even corporates, GM, Chrysler. In the US, the fiscal costs have been significant in the US, but also in the UK, in Ireland, in Iceland, in Spain, in other countries that had that bubble that went bust. So now we have large amounts of private debt, we have large amounts of public debt. In the extreme case, if they're not addressed, they're going to cause debt crisis or even sovereign debt crisis. And even if they are addressed, they imply that the painful process of deleveraging implies lower economic growth for a while until you deleverage. So certainly avoiding those excessive leverage and debt trap is one of the lessons that is important for both investors, governments, and for economies. There has to be a right balance between debt and equity, otherwise that becomes a burden over time on economic growth, and in some cases, in the extreme, leads to financial and sovereign crisis.
Fantastic, thank you very much. And the chap there.
Thank you. My name is Martin Borkovic, ProRate Slovakia. Dr. Roubini, you mentioned tensions in the Eurozone. As for Germany and peripheries, what would be your recommendation for monetary and fiscal authorities? And my second question would be whether there are any lessons that the Eurozone can learn from the federation of the other states like the US and the administration. Thank you.
Well, you know, I mean, I think that on the first part of your question is that we need fiscal austerity in the Eurozone, in the UK, in the US, in Japan, because otherwise you're going to have a fiscal train wreck. You might lose market access like Ireland and Greece, and that will be leading to spikes in interest rates that are going to jeopardize the recovery. So we need that fiscal austerity, but in the short run, raising taxes, cutting government spending, even inefficient government spending, firing public employees, reducing subsidies and transfer payments, those two things reduce aggregate demand because you're cutting disposable income and you're cutting spending. So in the short run, unfortunately, there's a recent IMF study that suggests that fiscal consolidation, however necessary to avoid a fiscal train wreck in the short run, it has a negative effect on economic growth, however that's going to be necessary. And if you add to that fiscal consolidation also monetary tightening, we live in a puzzle world in which right now the recovery is still weak in the Eurozone and the US. So on one side, we need still near zero rates, and we need more quantitative easing to maintain that recovery. On the other side, the more we postpone that recovery, the more there may be asset inflation, there may be commodity inflation, and other types of trouble in emerging markets that eventually could be a source of goods inflation, if not asset bubbles. So the real economy may require low rates for longer than otherwise, but financial markets might eventually become frothy if we postpone that policy a kind of normalization. So I think those are the difficult challenges we face, and on top of it, there are the long-term challenges that aging of population puts significant pressure on pension funds, on healthcare costs, and so on. One solution is, in my view, to index retirement age to the longevity of the population. When Social Security was created, the average person in the US was dying 2 years before he or she could get those Social Security benefits at the age of 60, 62. Today, longevity has been rising, life expectancy is closer to 75 to 80 years, while retirement ages remain the same. That's not a sustainable situation, and part of the solution, in addition to cutting benefits or raising payroll taxes and contribution, has to be to index retirement age to the longevity of the population as well.
Fantastic, thank you very much. I think we've got time for maybe 2 more questions. Let's have the chap at the back there, thank you. He's actually, I was well, him first and then he can go afterwards.
Thank you very much. Munir Amroni from West Imo Bank. So I work for a German bank, and I would ask a question relating to this industry. You addressed the risk related to the property sector across Europe, and there is a particular issue related to the wall of debt that is due for refinancing in the next 2 or 3 years across Europe. We all know there is a huge amount of debt. We all also have identified that the banks across Europe have very limited equity at the moment, and therefore there is a great uncertainty about the extension and the property related to these debts. You didn't mention this, I would say, issue regarding the property sector. Do you think this is not an issue, or do you think that there are, I would say, available equity on the market to fill the gap? Thank you very much.
No, I mean, it's a problem that one should recognize, you know, both, especially in commercial real estate, both in the United States and also in Europe. There's a significant amount of, you know, mortgages that were issued in the middle of the last decades, you know, maturities of 5 to 10 years. A lot of the stuff has to be rolled over, is coming to maturity, and in the US, commercial real estate prices have fallen even more than residential, by 40% as opposed to 30% from the peak. Lots of properties are also into negative equity. Of course, there has been some improvement in terms of, you know, capacity and so on. So I think that's a time bomb that has to be addressed. In the US alone, you have a couple of $1 trillion of outstanding commercial real estate loans. Half of them have been securitized. A lot of them are held by smaller banks and medium-sized financial institutions. And rolling over that stuff, whether it's in Europe and US, is going to be an issue. And compared to the United States, I think, as has been pointed out, the US has been more aggressively recapitalizing the weaker financial institutions. The Europeans have used regulatory forbearance so far to postpone that kind of an adjustment. And last year, there were a series of stress tests that everybody recognized were a bit of a fudge. In the next few months, they're going to do another round of stress tests. Hopefully, they're going to be more credible, and they're going to realize that many financial institutions in Europe need significant more amount of capital, and they need to recapitalize to avoid this process of excessive deleveraging. There's going to be a constraint for credit growth. And certainly, European economies depend on bank credit more than the American economy, where capital markets are more developed. Therefore, fixing the credit problems in the banking system in Europe is even more important than the United States to maintain credit growth and economic growth. So those are difficult challenges that we're still facing right now, and we'll have to address them and not kick the can down the road. Otherwise, you're going to make the problem bigger down the line.
Thank you very much. Having said we're taking another question, unfortunately, we've now run out of time, and I'll have to cut it short. Otherwise, many of you will miss your next meetings, I'm sure. At least to me, just to sort of summarize, really, I think we've heard you know, an awful lot in the last hour, really. It seems to me that we are going in the right direction, but clearly there are speed bumps and some pretty hefty headwinds, and particularly in the advanced economies ahead of us. So with that, I'd like to ask everyone to join me in thanking Dr. Roubini for his time and his words. Thank you.